Are you looking into the future? So are we. On today's episode, Nick dives into some future indicators to discuss what it all might mean going forward. Grab a cup of joe. It all starts now.
Hello, everyone. Welcome to the August episode of Cup of Joe. Mike Carrazzo, and as always, I'm joined by Nick Webb, our Director of Risk Management, Commodities Hedging. Nick, happy August.
Mike, I can't believe we're already this deep into summer. This is incredible.
I know. It's gone by so quick, and I think once 4th of July hits, everything just starts to accelerate and you get towards winter pretty quickly. But hey, it's almost college football season, so
we're going to have to come up with some bets for this season.
Yeah. How's Ohio State looking this year?
Big question mark at quarterback. I think our receiving core is quite strong. They're going to be good. I don't know if they're going to be great. We'll see.
Okay. All right. Well, depending on how the economy goes, we can make some wagers on that.
Let's do it. I'd love to.
So we got a really interesting episode here, as the intro indicated. Some future facing. Now, we can't make any predictions, and we're not making any predictions and all that, but there are some future indicators. We had gotten this request before, and Nick and I discussed how could we address the looking forward without making too far of a statement. So I think you got some great stuff in here this episode, Nick. But before we get into that, next month, September, we're not going to be live. Don't worry, we'll be back live right after that in October. But we're going to bring on 3 product managers: stainless steel, carbon steel, aluminum, kind of get an update from their perspective. And with Labor Day kind of falling in that first week of September, we said, might be good to pre-record this one. So we're gonna record at the end of August, get it out there to our YouTube channel, and of course, if you're subscribed to Cup of Joe, you'll get the email with it. And on that note, if you have questions for our product managers, please feel free to email those to us, and we can ask them. Unfortunately, we won't have the live session in September, but if you had some pressing questions you want to ask the product manager or Nick, of course, to email us, and we'll give out that email address because there's actually an interesting email we got. But before we get into that, Nick, I know you have a few things you want to get to.
Yeah, for sure. So first things first, before we hop into the full set of discussion items, a quick plug. I do want to make this discussion not just for Ryerson employees, but also for any customers that are on the call. As we sit here in the beginning of August, we are fast approaching what we like to call contract season. Basically, negotiations for looking forward into 2024. Might be a little early, but I want to make sure we at least plugged it because it is an important topic both for us and for our customers. And as you can see over on the right-hand side, that's a normalized chart of steel prices over 5 years, aluminum prices in the blue line over 5 years, and nickel prices. And if that doesn't look like a roller coaster to you, I don't know what a roller coaster looks like. There's a ton of volatility in commodity markets, and we expect that to continue. And with that, as we think about contracts for next year, shifting over to the left-hand side, there are a variety of different ways that Ryerson can buy and sell metal, and we are open to the gambit of them. And we want to be the partner with all of our customers in coming up with the best way that fits that any specific customer's needs, because every customer, the way they buy, the way they price their product out the door, it's all different. All the risks are variable, and we just want to make sure that we're acting as an appropriate partner, and that may include myself and my analyst Kevin Kucera as part of the risk management team. We may get involved, we may not need to get involved, but I think we should be having these discussions as we sit here in August, September, thinking about next year and as we plan into the future. So, quick plug for risk management, quick plug for partnering up with your salespeople and making sure that you're keeping close to markets, because we're still seeing a lot of volatility in asset prices. And then before we hop into our question that we got via email about a half an hour ago, which we're really excited about, it's a very loaded question. Before I can even attempt to address it, I have to cover the safe harbor provision, which is these are the opinions of Nick Webb, Mike Carrazzo. We're doing our best to get you the best content we can, the best information we can. But do your own research. This is not investment advice, but we hope you like the content. You enjoy the answers and discussion points we have for you.
Yeah.
So with that, I'll flip it back to you, Mike.
Yeah, to your point, right? So what? 20 minutes before we hopped on, we got a question via email from Dustin, and thank you for that. What was really exciting about doing this is Nick, we put you on the spot a lot with a lot of questions, and you never back down. So I mean, I think that's you have an answer for everything.
I got an answer. It's not usually right.
It's right. It's right a lot of times. But yeah, we always have opportunity for everyone that ask questions, and this one we got via email. Now it's a two-part question. Now the first one is there any correlation historically with interest rates and commodity prices?
Yeah, so this is a very loaded question because it gets into a lot of different parameters of economics. I'll slightly shift the question to not talk about the relationship between interest rates and commodities to start. I'll rather instead talk about the US dollar and commodities. And as many may know from listening to the podcast, there are a lot of commodities globally that, whether they're domiciled in the US or outside of the US, they often are priced in US dollars. So for example, the London Metal Exchange, when you go out to buy metal, it is US dollars per metric ton is the actual contract on the London Metal Exchange. And why that's important is when you have a commodity that's priced in US dollars, what that ultimately means is if the dollar were to strengthen or get stronger relative to other countries' currencies, it actually makes it so that our dollar becomes more viable to buy that thing because it is priced in that asset. So as the dollar strengthens, it takes fewer and fewer of them to actually buy the same amount of commodities. So you get this inverse relationship where the strength of the dollar actually causes commodity prices in general to weaken. It's not a perfect science, but the dollar and commodities tend to act in inverse ways. It's similar to the analogy of, if you're trying to travel to Europe and the dollar has strengthened substantially, all of a sudden your vacation to Europe just got cheaper. It's kind of a similar phenomenon with commodities as well. If you're trying to buy a house in Turkey right now, you can probably buy a house in Turkey for an extremely low amount of US dollars because their currency is getting destroyed. So they're all similar iterations of the same thing. Now, why I wanted to bring up the dollar first is because the dollar tends to have relationships with interest rates as well. As interest rates tend to go higher and higher and higher, that makes investing in the US government debt more and more attractive. Because interest rates are going higher, both domestic parties as well as foreign governments, foreign people can buy the US government debt and get a higher and higher interest rate. So what that means is they're actually demanding US dollars. So when you think about supply demand dynamics, as one would demand more dollars, that causes the price of the US dollar to go up in general. That's on the whole very broad spectrum. May not be true day to day, but that's the broad idea. So there tends to be kind of a linkage where interest rates have an effect on currencies, and then currencies have an inverse relationship on the price of commodities. So that was a very long-winded answer to this question. There was actually a second part to the question that I want to address as well, because I had not looked at it. And that was, the question was, do utilization rates by chance have a relationship with interest rates? And I did have a chance to actually pull up a little bit of data on this. I didn't have a whole lot of time, so I pulled up this quick chart. This is going back to 1990. And what we're looking at is the white line is going to be the Fed funds interest rate. So that's basically your spot interest rate. And then in the blue line and the orange line, so the blue line is going to be steel capacity utilization. The orange line, which almost looks like a moving average of the steel utilization, that's more the broader economy productive utilization. So that's basically of the productive assets, not just steel, but in general, how is our utilization looking as a country? And you can see they're fairly correlated. what I noticed, and thank you for the question, because I hadn't actually dove into this, but I think it makes sense. There appears to be a relationship, and it's lagged, where as interest rates go up and up and up, once they start to roll over and come back down, there tends to be a lagged relationship to utilization. And the way I think I would explain that is, when you get interest rates going up and up and up, the attempt is to cool off the economy. A lot of times they are successful. The federal government, as they hike interest rates, sometimes they're going to be successful. As they hike rates, they slow down the economy. What happens when you slow down an economy? Well, you have less need for your productive assets, whether that's to make steel or to make goods and services. If you're successful in slowing down the economy, that's going to have a lagged impact on utilization. I would say you can see that pretty clearly in all of these peaks. As they roll over, there tends to be maybe a couple month lag to utilization rates coming down. And that's true both for steel and for the broader US assets.
Yeah, this was a really good question, and and really digging into it, and it touches on a lot of things you're going to get.
It touches on a lot of things for sure, and we're going to touch on some of these topics here in a few slides, which I'm excited about. But no, they're great broad questions. Yeah, was there one other one that you wanted to address? Are we good there?
Yeah, no, let's go forward, because I think you got a lot to get through, right? You know, interest rates have jumped again, and dollar, some things going on there, and the steel prices. Let's get into it.
Excellent. Cool. So first things first, I've got a couple slides that we typically touch on, covering the broad economic landscape, particularly for manufacturing. And then I've got a series of slides and topics and charts that I want to cover that I don't think we've really discussed at length, but I think we'll have some fun with it. And I do want to be, completely honest. Some of them might give a tinge of bearishness, and I want to make sure I'm fairly balanced in the discussion. So if anybody has a hate mail for me for being too negative in my commentary, certainly send it our way. Not the intent at all, but let's go ahead and hop into it, and we'll see where we go with it. So this is the global PMIs for manufacturing. And again, as we look left to right, there isn't a whole lot new to the story. It's really a continuation for most regions of the world. What I mean by that is, where they were, say, 2-3 months ago, for the most part, they're generally trending the same direction. And what I would point out here would be, on the negative side in particular, the Eurozone is really struggling. Whether you're looking at France, Germany, the broader Eurozone, Austria, I don't have it in here, but Switzerland had a really weak PMI. If you've got European friends and they're in the manufacturing business, give them a call, because it's tough times right now.
Germany.
Completely to the opposite. Sorry, go ahead.
I'm sorry, Germany just stuck out to me here at 38.8.
These are ugly numbers. Yeah, there's actually a headline that I came across just earlier this morning that was saying that their exports in a large way are to China. Their exports are down massively, and the article was suggesting they may never come back, because China is starting to produce what they had been purchasing from the Eurozone. Whether they can make it cheaper, more efficiently, keep it more localized, that would be a longer term potential headwind for that area. They're still dealing with the energy issues, like, lack of energy security. We're having a hot summer, a lot of need around that. So yeah, there's certainly some amplified weakness out of that area. And you mentioned the Germany PMI, 38.8. I mean, that's one of the lower numbers, certainly going back towards the COVID lockdown. So they're not great figures. Now, contrasting that, we still have the situation, and it's just a green tape going straight across the screen. India continues to outperform. It seems like, one man's trash is another man's treasure sort of thing, whereas as Europe has basically blockaded themselves off from cheaper energy, it seems like India has really opened their doors for it, and they're using that to really amplify their manufacturing economy on the upside. Now, the two big ones that I always like to touch on, China, the United States, it's not horrendous, but it's weakness in both cases. We're seeing a little bit of softness, just sub 50 on the PMIs. So, for the broader manufacturing economy, both within China and the US, it's tepid slowness, I would say, is the general theme. And that's really kind of summarized down in the very far right-hand corner, which is showing the global figure of 48.7. That's a pretty good barometer of where we're seeing things if you take all of this into consideration.
If you think, I know we've asked this in months past, but the 53.2 for Mexico, and it's been steadily increasing. I mean, is that somewhat related to nearshoring? I know that's a question we ask in some flavor, but
I'd say a bit related to nearshoring. I'd say certainly a bit related to automotive coming online as well. Production numbers in automotive are ticking higher, and there's a lot of that down there. So yeah, I think there is a reason to be optimistic in that region for sure.
Yeah.
Looking at the ISM as it relates to U.S. specifically, it is a continuation of the theme, which is a bit of a slowdown within U.S. manufacturing. Slight bit of good news. Not trying to, split hairs or anything, but if we look at the June data relative to the July data is incrementally more positive. So what that ultimately means is, yes, it's still slowness. Yes, it is still contracting, but it's contracting at a slower pace. So a tiny bit of optimism in what otherwise looks like a somewhat weak manufacturing report. And it's again, on a month-over-month basis, every line item across each one of these individual pieces is sub 50, and that's been the case for the last couple of months. That being said, it's not all bad news in both U.S. and China. And I've seen a couple of people on Twitter and in the news dub these types of economies the two-speed economy. And what they mean by that is ultimately manufacturing only makes up a portion of the United States and Chinese economies, probably more heavy in China. In the United States, manufacturing is estimated to be somewhere around 20 to 25% of U.S. production. So we've got this situation where in both the United States and in China, the PMIs on the manufacturing side are sub 50. Counteracting that on the flip side, and in the United States, which is a much larger piece of the economy, you've got services PMIs currently running at 52.7, and in China they're running at 54.1. So you have this scenario where, yeah, we may be seeing a little bit of a manufacturing slowdown, but at least for now, there's a little bit of a breakdown and a spread occurring where the services economy, which is going to be retail sales, travel, leisure, hospitality, things like that, are actually doing quite well. And we've talked about that in prior Cup of Joes, where we talked about travel numbers in the U.S. Looking at TSA are just they're at all-time highs, and people spending money on Taylor Swift concerts and Beyonce concerts. It's keeping the entire economy afloat. Those are the types of things that are feeding into this two-speed economy, where at least for now there's a breakdown and correlation between those two things. So it'll be interesting to see how that spread develops over the coming months, whether services will break down towards the manufacturing numbers, or if instead we'll see the manufacturing numbers actually tick back into positive territory and see some regain growth.
Yeah, I saw a report that they said this year are actually taking their vacations, right? Like in the past few years, of course, and then with COVID, you couldn't travel a lot. And even over the last 3 years, I think travel's kind of trickled back.
Yeah, for sure.
Yeah, it said that everyone, that has their vacation is utilizing them and actually traveling places.
Yeah, and a quick aside, I mean, in China, they had they call it their Politburo meetings about 2 weeks ago. And a lot of people were hoping that big major infrastructure stimulus is going to come out of that. I would say it was a little more tepid than what expectations were. But one of the things they did encourage is they are trying to actively encourage flight travel, both domestically and abroad. So the same theme is happening within Asia as well.
Yeah.
So before we hop into this, again, I need to preface this by saying, when we think about the future and we think about our crystal ball, I can't tell you for sure what's going to happen. But what I can tell you is I can give you stats. I can give you stats on how business cycles and economic cycles have played out in the past. And we can use that to kind of create probabilities on what we could expect in the future. It's not a guarantee. And I want to make that very clear. These are not guaranteed forecasts, but we can put some sort of probability around them and use them to make better educated decisions as we look forward. So keep that in mind as we think about the next couple slides. But before we do, I'm going to give you a clip of Jay Powell, the central bank chairman.
Sound's not coming through. Would you share your sound by chance?
Since we're almost through it, I'm gonna let everybody read it. But yeah, I apologize if you're not getting the sound. I'll give it to you in a sec.
You're watching live.
That's right. So the key discussion or the question was, how are you seeing the odds of a recession as we look forward? To paraphrase, Jay Powell said, myself and the other Fed presidents, we are not currently forecasting a recession, which is a bit of a, I would say it's a bit of a surprise, because for the last 12 months, it seems like most talking heads, maybe including myself, have been talking about this potential that as we're hiking interest rates, as we're trying to bring down inflation, there might be the accidental whoopsie where you slow down the economy too far and take us into something of a material slowdown, which could be deemed a recession. So there's Jay Powell's opinion. He is not forecasting a recession, which is totally fine. That's his opinion. They got plenty of models that support that. It is also worth noting that Goldman Sachs just recently, in the last couple of weeks, lowered their recession odds for the next 12 months from 25% down to 20%. So perhaps that's in the Jay Powell camp. What I want to do is talk about the potential headwinds or hurdles to that potential stance. Not to say I'm right and they're wrong, but I just want to provide some data to give us a good debate factor.
I'm smiling because if everyone recalls, the wager from last fall was what would happen first: Ohio State loses or a recession is declared, right? So if Ohio State didn't lose and he just came out and said he's not going to declare a recession, I mean, your hair could have went for years.
Yeah, I mean, here I am 12 months forward and I still look like an idiot. So, and I will say I don't believe I'm alone in that. If there was a Bloomberg forecast model, one of them in particular was looking at 12 months forward, and it was sitting at 100% odds in August of 2022. Okay. So it's already been wrong. I was wrong on how and when that recession. I put recession in quotes because it is still something that is. The official recession has to be deemed by the National Bureau of Economic Research. So there is a group of people that has to declare it. But we'll look at a couple different things that suggest that at least provide a topic for debate here in this discussion. But before we do that, I want to hop on what things could Jay Powell or Goldman Sachs be looking at to say the recession is not pending, this imminent doom. Although I don't think it's actually imminent doom. Why isn't it coming? This is looking at the Citi Economic Surprise Index. So what this is doing is, for the United States in white, the China in orange, and Europe in blue. This is what the index is essentially doing, is taking economic data points and economist forecasts of where those data points are going to land. And if the actual number comes in and exceeds the economist's data point, that would tick this index higher. And more actual data points that come in above expectations, that would take the index higher and higher. And then the reverse would also be true. If actual numbers come in and they miss analysts' expectations, we would see this index go negative. And worth noting, in the last couple months, we've had a barrage of positive economic data points relative to expectations. I think it's important to say relative to expectations, because it doesn't necessarily have to mean growth or weakness. It's just, where were expectations? How were people feeling about the economy? And is the actual data coming in better? And for the United States, unlike the other two regions, it is coming in better. And I'll just quickly allude, there was a second question from our guest that came in, and the question was essentially, how do you explain things like equity prices rallying close to all-time highs again? And this is one of the support factors for why I would say that's possible, is that economic data has actually surprised to the upside up to this point. And similarly, if we look specifically at equities, I guess spend the most time maybe either in the top right section or the bottom left section. What this is ultimately showing is, where did individual publicly traded companies, where did their earnings and their revenues coming in relative to expectations? You can see the sales surprise, that would be revenues, earnings surprise on the right. Almost across the board, we're seeing earnings and revenues exceeding expectations. And again, I want to make sure it's clear, this is relative to expectations. If we were to toggle this and switch this over to the growth section, earnings and revenues are actually declining slightly as we sit here right now. But this is more of a function of analysts just got a little too bearish, and the data that's actually coming in is better than expectations. That's really the point I want to make is, and that's really all you need with asset prices is where were expectations? Were they too high? Were they too low? In this case, they were too low. And then as the actual data came in, asset prices like equities performed quite well, at least up until the last couple of days. So that slightly addresses the second question that had come in. Now, as we look at the broader, so we're not looking at Jay Powell, we're not looking at Goldman Sachs, we're looking at the broader industry of analysts who are trying to forecast these things. This is looking at recession odds across a broad market of analysts and economists. And as we sit here right now, they're viewing the odds of recession in the next 12 months at 60%. So I would say that's a fairly stark contrast from where Jay Powell is saying no recession and Goldman Sachs is saying 20% of a recession. So this kind of leads us to the other side of the coin to say, well, why are we seeing such a divergence? Why are we seeing some analysts expecting a recession or forecasting a recession in the next 12 months? And again, making it very clear, these things are not guaranteed. All we can talk about is probabilities. So first things first, this is going all the way back to the late 1940s of data. So this is where I'm saying we're looking at some new charts that we haven't historically looked at. I'm trying to go as far back as we can to get as many instances of these occurrences as possible. What we're looking at here is the ISM manufacturing index. And what I've done is I've overlaid, and I've done this on all these slides, I've overlaid these red vertical sections, which are official recessions per the NBER. They're a little hard to see, but I can tell you over this time period, there's 16 of them. And over this time period, the ISM manufacturing, anytime it's dipped at or below 46, it has signaled a recession 12 out of 16 times. So it's got about a 75% hit rate. So I asked my analyst, who's a big basketball player, I asked him to give me an example of a free throw shooter who shot 75%. So this is basically LeBron James. That's about how effective the ISM is in predicting or coinciding with a recession. And it is worth noting that last month, we got a small uptick this month, but last month we did see ISM at 46, right on the dot. Now, again, making it very clear, it is not a perfect indicator. It's 75% of the time. Could it miss? Absolutely. But as we sit here right now and looking back over the historical cycles, it looks like when data gets down into this range, it tends to coincide or precede a recession.
Yeah. Hitting 46 within the year, or does it happen like shortly thereafter? Or what?
Yeah, it would happen shortly thereafter, or it can happen simultaneously. We're just looking at where the data point is relative to these vertical red lines. And we're doing the same thing in the next couple. So the next one has a little longer history. We're going back to the early 1920s, so back almost Spanish flu time period. We're getting into the early stages of the Roaring 20s, and obviously in the 30s you had the Great Depression. But this instance has 22 instances of recession. Industrial production, which measures just the manufacturing, industrial output of an economy. We're looking at the data on a year-over-year basis. And anytime industrial production has dipped below 0%, so in other words, it shrank. Anytime industrial production has gone below zero, 82% of the time, or 18 out of 22 times, it has coincided with or preceded a recession. So again, talking basketball terms, this is Kobe Bryant shooting free throws, little better than LeBron in terms of his free throw abilities. And as we sit here right now, we actually are in slight negative territory. So again, both the ISM and industrial production, they've only very, very slightly breached the thresholds that we're using in these probabilities, but they are in those territories right now. So again, this is a little better odds of either forecasting or coinciding with a recession 82% of the time. Flipping to the lending side of the equation, there's a recent data point that came out earlier this week. It's called the SLOOS report, which is the Savings and Loan Officer Opinion Survey. So the SLOOS, And what they do is it's similar to the ISM, but they're going out to loan officers all across the United States and saying, are you increasing your lending standards, or or said a different way, are you lending more or are you lending less? Are you seeing things better? Are you seeing things worse? And if we look at commercial and industrial loans to medium and large size businesses, this is the number of respondents, or sorry, the percentage of respondents that are suggesting they are tightening standards versus loosening standards. So in other words, they're putting out less loans or being more stringent on loaning into these types of businesses. Anytime we've seen this survey tick above 50%, so in other words, more than half of the respondents are saying they are tightening lending conditions, it has either coincided with or preceded a recession. And I think it makes fundamental sense. If a central bank is hiking interest rates, and if loan officers are saying lend out less money, that at some point could or would be restrictive to an economy until or unless you have a society that just doesn't need debt anymore, which I suppose is a slight counteracting factor to this. There's been a lot of money printed. Maybe you've got more and more businesses that just don't need money. But this one's got a little less history, and I want to make that caveat. This is only going back to the early 1990s, which is as far back as the data can go. But again, you can see the distinct relationship between credit tightening and recessions. I've got two more, I promise. I'll stop being such a wet blanket. This one has not yet occurred, and it's a ways off from occurring. But this is looking at, and I know we've talked about this in the past, the 2-year Treasury yield versus the 10-year Treasury yield. And I'll give a quick background on what we're looking at here. 2-year Treasury yield versus the 10-year Treasury yield. In a normal market, 2-year yields are typically lower than a 10-year yield. And the reason for that is because if you're going to take 2 years of credit risk to a government versus 10 years of credit risk to a government, if you're going to take 10 years, you would expect to get paid more because you are taking a longer duration of counterparty risk to that entity. There's a higher likelihood that that government or that company could go bankrupt and not be able to pay you back. So in a normal market, a 10-year interest rate is typically higher than a 2-year interest rate. Well, we're in a phenomenon right now where that's not the case. And that's not the case because we're in a very quick rate hiking cycle. So the Fed funds rate, 2-year Treasury yields, all of the nearby interest rates are going up at a very, very fast clip, basically reflective of what Jay Powell is doing. Meanwhile, the 10-year Treasury is already attempting to look beyond this and say, well, at some point, they're going to have to stop hiking. At some point, inflation will get under control. And at some point, the Fed will actually bring interest rates back down into a more normalized range. And when that happens, when that phenomenon occurs of looking through the rate hike cycle and saying things will get back to normal, you get what's called a yield curve inversion, or in other words, this white line goes below zero. So we've talked about it in the past as being an early indicator of a recession. And historically, you can see that and pretty much any time the yield curve has gone below zero, it has been before. And when I say before, it can range anywhere from 8 months to 24 months on average. Every time can be different. Every time is different. But what's interesting is it's actually when the yield curve goes back into positive territory, or said a different way, uninverts. It's really when it uninverts that we've got the issues. We're still sitting all the way down at negative 71 basis points. So we're ways away from anything inverting, which means that recession that we've been kicking around is not yet here. Now, I would probably take a step back and say, as I said at the beginning of this slide, the normal state for the yield curve is positive, meaning it would be 2-year Treasury yield is lower than the 10-year Treasury yield. So in my opinion, it's a matter of time until this shape of the yield curve goes back into more of a normalized state. And that may coincide with some sort of recession. But we don't know if that's going to be 3 months, 6 months, 12 months. But what we can use is probabilities, and using the historical instances where it's happened in the last 6 times, it has precluded, the inversion has precluded the recession by about 12 to 24 months. And I apologize, my dog just found the perfect time to play with her bone. Last but not least, and this one has 100% accuracy and a whole lot of data, And I think it makes sense why it has 100% accuracy, because this is probably the best gauge of whether or not an economy is in recession. And the good news here, and I want to make sure this is seen as good news, the good news is the employment picture in the United States is still extremely positive and does not really show any immediate signs of abating. But if we do entertain this idea for a second, and we consider the idea that in order to have a recession, 100% of the time, the unemployment rate has had to increase by at least 150 basis points, or 1.5%. We're sitting right now at 3.5%. And as you can see on a historical basis, that's extremely low. We have a very tight labor market still, even with all of the job losses that have occurred mostly out of Silicon Valley and some of the financial sector. So we have seen very, very little loosening of the unemployment rate at this stage. So if you're trying to prepare, because that's really the point. None of these slides are meant to scare anybody on this call. They're meant to act as a preparedness factor for Ryerson and for our customers to try and make the most sound decisions on economic conditions. And this one is not flashing red lights at this point. We're going to keep an eye on it. And certainly if we see unemployment tick above 4%, we're going to have a much more keen eye on the employment picture, because that seems like the most sound instance of really precluding or being intertwined with a recession. So a little bit of good news there, which is the employment picture looks very, very strong. The yield curve is still showing no signs of uninverting. So there are a couple bright spots in what looks like otherwise what Jamie Dimon recently called storm clouds that could be out on the horizon.
So to recap out of those five, right? So you had PMI, industrial, lending standards, yield curve, unemployment rates. We're currently have hit three of those, PMI, industrial, and lending standards, but we have not hit the yield curve and unemployment.
That's right. That's right.
Would it be fair to say that since the last three, so unemployment rate, yield, and lending, 100%, right? We've only hit one of those. That would be fair to say that maybe they're right about no recession. I don't want to put you in a spot, but like saying that like the ones that hit 100% of the time, albeit short, small.
Yeah, I mean, I think that's an optimistic way to look at it, but I think it's also an accurate way to look at it. Talking the other side of the equation, I showed 5 charts. 3 out of the 5 were showing a recession at some point in the near future. 3 out of 5 is 60%. If you remember back, the recession odds right now are sitting at 60%. That could be essentially the art that they're using to compile that index. But yeah, you're exactly right. The 2 that are the best predictors, the ones hitting the perfect game, are the ones that are still not flashing red lights at this point.
Yeah, great data. No, that's a great look at those. That's really good.
And the one other caveat that I don't want to belittle is the idea that yes, the manufacturing economy is in what looks like a soft territory, but it's worth noting, worth keeping in mind, the manufacturing economy is still 20 to 25% of the U.S. economy. So if services remain strong, balance sheets of the individual consumer remain strong, this party can keep going on the way it's going. I mean, I don't think it's a bad idea to remember the fact that we printed several $1 trillion in the last couple of years, and there are much stronger balance sheets at the individual level than we've seen in a long, long time. So it may be the case that what's happened in the last couple of years has changed the equation a bit. Now, some of them I think have very obvious ramifications on the economy. If every loan officer and their brother is tightening lending standards, yeah, at some point that's going to tighten up market conditions. We just aren't seeing it just yet. And last but not least, this is the forecast into where market makers, traders, analysts are thinking rates are going to go. So as we sit here right now, the market is essentially saying Jay Powell's done. They aren't saying it's time for cuts just yet, but as we sit here right now, 5.5% on the Fed funds rate. It's been a big journey to get here. We've raised interest rates by 500 basis points. It looks like they're going to stay here at, I would say, best case scenario until or unless one of two things happens. Either one, they are very confident that they've won the inflation fight and they can do no wrong by lowering interest rates, and that's not going to reignite some secondary inflation wave. Or the other thing would be an actual economic distressful situation like a recession. Until or unless one of those two things happens, it looks like they're probably going to keep rates flat at best. There's an expectation that something, whether that's inflation coming down further by early 2024 or recession by then, there's an expectation that for whatever reason they think Jay Powell is going to be able to be cutting interest rates come 2024. We'll have to wait and see. This graph is certain; these probabilities have certainly been wrong for a number of periods leading up to this point. But it's a snapshot as of today. And the last thing I want to drive home, because I do want to make sure nobody's sending me hate mail to my home. GDP right now is tracking per the Atlanta Fed GDP Now Index at 3.9%, which is a very good number when you look at this on a historical basis, not just on a one-year basis, but even a longer-term basis. 3.9% GDP. We could argue about whether or not GDP is the right index to use, but I want to make sure I drive home the point that economic conditions on a broad basis are still pretty okay at the moment. Now, last but not least, this is the reason why we're all here, wanting to get in metals prices. And with every one of these metals prices, I also have forecasts, which hopefully, I think that's going to be something that's fairly new for a lot of these Cup of Joes. We don't typically talk forecasts. And I do want to make it clear that these are not Nick Webb's forecasts. These are not Mike Carrazzo's forecasts. These are bank forecasts that get compiled and summarized on Bloomberg, and then we just display them for you. So these are not my opinions. These are the market opinions. But looking at carbon steel,
right?
What's that, Mike?
Well, they're not right.
Yeah, exactly. Looking at carbon steel, been a roller coaster ride. We have certainly seen U.S. prices come back down to earth in the last couple of months, and there's even been a little bit of convergence in the last couple of weeks and months. It's not much, but ever so slightly in the bottom right corner, you can see Chinese prices in US dollars per short ton. And with a little bit of optimism coming out of the Chinese Politburo meetings, and I will say it's a little optimism, it's not glaring optimism. There's been a little uptick in Chinese steel prices. That combined with the fact that we're seeing US prices come back down to earth a little bit is just creating a convergence in markets. And as we look forward to what I would consider probably the best forecast for any point in time is steel futures contracts. These are probably our best gauge as to where the market thinks steel prices are going to be over the next 12 to 18 months. The blue line is 6 months ago, the green line is 1 month ago, and the orange line is current. And what's interesting when you look at the blue line 6 months ago and the current number or current numbers, there really isn't much deviation in those. It's 20 to 30 bucks in where we would have been forecasting 6 months ago versus where we are now. As most know on the call, we had a bit of a journey to get here. It certainly wasn't a straight line, and you can see that evidenced by the green line, which showed that we did actually get to a point where we were seeing prices fairly close to $1,000 per ton on hot rolled coil steel. We've very quickly come out of that cycle, and despite the fact that U.S. mills have announced a round of price hikes about a month ago, it looks like they did more to kind of stop the bleeding than they did to actually reignite a price increase. So for now, it's really kind of looking like stability is ahead. Now, every time I say that, it tends to be wrong. Something happens, a mill blows up. And I don't mean to joke about that sort of thing, but this, as we sit here right now, it's basically saying plus or minus 20 or 30 bucks is the forecast for the next $18. That probably won't be exactly how it goes, but in terms of thinking about fundamentals, I think we're in a more comfortable range where both buyers and sellers can buy and sell steel profitably, make money making their manufactured products. So fairly mundane within the carbon world. On the aluminum side of things, again, similar story where, as I was talking about the Chinese optimism, it's tepid, but there's a little bit there. You can kind of see that here in this chart, and I drew in this channel, which I referenced last month in Cup of Joe. We have broken out of the channel. We have started to trade above at least the 50-day moving average. There's small signs of optimism that some of the stimulus matters that are taking place, not just within China, but also in the US, are going to be supportive of the light metal of aluminum. China has been very, very rhetorical in talking about their efforts to support quality growth. And what they mean by quality growth would be not your traditional real estate sectors, which is what they did for the last 20 or 30 years. It would be more focused on technological infrastructure in general, electric vehicles, and all of those things tend to be more supportive for things like copper, aluminum, nickel. So we have seen a little bit of optimism since they broke from that Politburo meeting. It's not massive, but there's a little bit of optimism within the LME market. Looking at Midwest premiums, and what I've overlaid with Midwest premiums is the truckstop.com flatbed trucking index. It's not a perfect correlation, but it tends to be a good representation of getting metal around North America. And as you can see right now, the trucking index, which is shown in the blue line, is suggesting that there may be a little further weakness in premiums as we roll through time. That's kind of been the case for the last month or two. And so would we, I wouldn't be overly shocked to see 20 cents per pound in the coming weeks and months ahead. It's really kind of been a slow bleed up to this point, but it looks like that's really where the market is targeting for now, until or unless we get additional tariffs or see a big boom in trucking demand and that market gets tight again. And then lastly, on the aluminum side, this is looking at these bank analyst forecasts. And there are a lot of lines here, but you can see down below, we've got the legend showing that the darker blue line is going to be your median forecast looking out to 2024. Mean is red. And then you can see the highs and the lows of the bank forecast, which you almost have to throw those out because they are a little extraneous. It's usually one bank analyst who's hyper bullish or hyper bearish. I would almost recommend taking those out. But when we take the current futures market and we take the current median and mean forecasts, and we consider the fact that right now we've got LME prices right around $1 a pound, there's essentially about a 10% increase in the forecast of where LME aluminum may go over the next, let's say, 12 to 15 months. So small bit of optimism there as we sit here today. And I guess the one point I want to make in all this is all of these factors and all of these price forecasts can still be true even if we do have a cool down in markets, even if we do have recessionary conditions. It is possible that sometimes fundamentals, like supply demand fundamentals of a particular metal can outweigh any broader recessionary risk that may exist. So, again, I would also say that all of these analysts that are compiling these forecasts are certainly taking into consideration any economic headwinds that exist out there. They should be built into their forecasts as well. Looks very similar on the nickel side, where we've seen beaten up prices for the better part of the last 6 months. I drew in the channel again, which I think I referenced in last month's Cup of Joe. But in the last 30 days or so, we've seen a small bit of optimism, small bit of price rebound. That could be people just trying to take advantage of the fact that prices were so beaten up over the last 6 months. So technically, it looks somewhat optimistic on the nickel side of things. I do want to note while we're on this slide, however, in the last 30 days, there's been some interesting news coming out of the London Metal Exchange. What's happened is, and I know we've talked about this in the past, exchange inventories of nickel on the LME, which is mandated to be class 1, which is refined nickel. It's also mandated to be from certain producers. They have a certain list of approved brands of metal that they allow on their exchange. And those volumes on the exchange right now are pretty lean. They've been dwindling for the better part of a couple of years. I would argue that's at least part of the reason why we saw a short squeeze on the LME, because ultimately the LME was not a good representation of the broader nickel market globally. I know we've talked about that in prior Cup of Joes. What's worth noting is they are trying to make efforts to fix that issue. May not sound like a whole lot, but in the month of June, a new producer applied to be a supplier to the London Metal Exchange, and they actually got fast-tracked to be approved. So there's a new producer of class 1 nickel that's going to be allowed to put their metal on the exchange. The reason why I think that's noteworthy is perhaps more symbolic than it is, purely going to be seen in data. But this idea that the LME is willing to fast-track entities in about 30 days, that's a pretty fast process to say they're trying to make efforts to bring more class 1 nickel onto the market so that the LME can regain some reputational risk in terms of its need or its use as a market pricing mechanism. So it was only one supplier for now, but there are rumors flying around that there are going to be a number more suppliers of class 1 that will get approved in the coming months. And with that, over the next 18 months, there are a couple of analysts that are forecasting about 200,000 tons of new class 1 nickel coming to market over the next 18 months. So that's about 30% of new class 1 production that should be coming to market. Some of that could be approved to go on the London Metal Exchange. And in my opinion, again, Nick Webb's opinion, that should help to add more supplies, add more availability to the London Metal Exchange, to ultimately close this gap between nickel pig iron prices and class 1 nickel. That's my hunch. And I think that's even the effort. They would probably even admit it at the LME. That's their goal, is to really fix that gap between what's happening in secondary nickel and class 1 nickel.
For context, where is it that a new producer is allowed to the LME? I mean,
I apologize. You're a little difficult to hear. Could you ask that one more time?
Oh, sorry. So for context, you said new producer was been fast tracked, approved on LME. Does that happen often that a new producer is allowed on or brought on?
No, it doesn't happen often. And that's one of the reasons why I think people are so surprised and taken back by it, because in my career, I'm not aware of any new suppliers coming online. It's certainly a very infrequent thing for that to occur. And yeah, the speed at which it occurred and the fact that it happened even at all was I think what shocked the market a bit.
Do you think it's getting pressure from, we thought you talked in earlier with your Cup of Joe's, so maybe competing exchanges for nickel? Do you think that played into anything in this?
Yeah, I think the threat of competition is certainly playing a role. I can almost guarantee you, I don't want to put words in their mouth, but I can almost guarantee you that most exchanges in the world who allow metals to be traded on their exchanges, I've got to imagine they're chomping at the bit for the LME to make one more screw up, so that more and more people push them away and go to different exchanges. They're certainly in the business of getting more players on their indexes as well. Looking at forecasts for nickel, little different story on the price of nickel. I'll in particular pay attention to this top line, which is the median forecast. We're currently sitting with nickel prices right around $9.80. As we look forward over the next 12 to 15 months, the market's basically saying flat to slightly down. I would argue that part of that is because there's an expectation that a lot of class 1 nickel is coming online over the next 12 months. As I mentioned, it's about 30% of new supply. So even with some of these things like electric vehicle production really demanding more and more nickel into the lithium ion batteries, even with that trend occurring, there is a lot of nickel supply coming online as well. And that's why I think the expectations are a little more tepid, a little more flat within the nickel side of things as we look forward. And then we don't do a whole lot of copper, but I know this is something that some of our viewers, some of our listeners really appreciate. So we have to cover the copper side of things. Copper right now, I think, is trading right around $3.90 a pound. We look at the forecast, whether you're using the median, mean. I mean, even the highs and lows aren't too crazy. It's basically saying, I'd say, flattish to plus 10 to 15%. So a little bit of optimism there. It is worth noting that we have seen copper prices hold up much better relative to nickel prices and aluminum prices over the last 12 months. One of the big reasons for that is just the fundamental side of things. Chile has been having some production issues, both related to geopolitical issues, basically strikes, and also just general operational issues. So production issues out of Chile have helped keep the copper market a bit more supported. And as we sit here today, the expectation in the next year is that the prices will be supported and perhaps even inflated by about 10%, let's say.
Pretty bullish on copper. Yeah.
Yeah. I mean, been optimistic, and I think the long-term prospects, probably the long-term prospects of all three, nickel, copper, and aluminum, all look pretty good. But I think copper probably more so than any of the others, just with the electrification themes as we transition into the renewable economy. I think it looks very well positioned, and the market looks pretty tight too, particularly when Chile is underperforming the way it is. So last but not least, I feel like I always have a quick kind of aside, not really directly related to the metals business, but wanted to touch on it real quickly. Earlier this week, and this doesn't happen very often either, the U.S.'s debt, so the federal government's debt, actually got downgraded from AAA to, I think, AA+ by a rating agency called Fitch. There are some in the market who are saying this is a bunch of BS, the timing is terrible, this is all political. I don't want to get too deep into the whether it's political or not woods, but I did want to show a couple quick charts because the last time the United States got downgraded was back in 2011, which would have been right around here. And what we're looking at in this top chart is the US federal debt as a percentage of GDP. And back around that time when we got downgraded, one of the big arguments was that debt to GDP was getting too close to 100%. At that time, it was, I can't see it exactly, but probably in the 90s. Well, in the last couple of years, we actually got as high as about 130%. It's come down a little bit, but we're certainly at more elevated levels in terms of our level of debt. And we all know the reason, or at least one of the big reasons why. It was a lot of money was printed, a lot of money was put out into the economy to counteract COVID lockdowns and the impact that that would have on the economy. So right, wrong, or indifferent, though, the number is, in fact, a fair amount higher. The bottom chart is showing the level of interest expense. So that is basically the amount of interest that the government has to pay to those who buy the debt. And worth noting, this data is only updated on an annual basis. And as of 12/31/2022, the percentage is 1.8%. If we updated that now, given the fact that interest rates have risen the way they have and the debt levels are where they are, the current approximation is that it's right around 2.5%. So looking at historical data, as a percentage of our overall GDP, interest expense is certainly on the rise, and it's on the rise in a quick way, not just because debt levels have risen, but also because interest rates required on that debt have risen. So I'm not here to say that it's not an issue. This is something that I think we want to keep an eye on as a country, as politicians. Not a trend we would want to see continue, because if we can't pay our debts, obviously that becomes an issue. But I do want to provide a little bit of I guess clear heads prevailing. Jamie Dimon was given a pretty good interview, and if you haven't heard it, he was on CNBC yesterday, and he was asked a question. He said, "This is ridiculous." He said, despite the fact that we do have inflated debt levels, and yes, we want to address them, he basically said there are very few places in the world that can do much of anything without the United States involvement from a credit and lending and business standpoint. And I think there's a lot of truth to that, at least for now, and probably for the foreseeable future. The United States is still in a very good place, and arguably the best place financially relative to about anybody else on the planet. So it's a little bit of smoke and mirrors in terms of the downgrade itself. I don't think it has much ramification on the metals business or any of our customers' businesses. Certainly not in the immediate term or in the next couple of years, I wouldn't think. But I wanted to make sure I touched on that.
Yeah, very, very newsworthy, actually. And Nick, how much, I know this has been talked about before in the past about the possibility about the U.S. dollar losing its global reserve status, right? And that talk has kind of come up again. Does that compound into what we just talked about too, with losing the
Yeah, it's definitely related. It's related to those prior charts, which is if we become, a debtor who doesn't pay our debts, people are expecting 5% yields right now, and we get to the point where interest expense becomes such a large part of our tax revenues that they can't pay it. Yeah, that becomes a risk to the solvency of our country. You would expect, the main way we would counteract the ability to pay debt is print more dollars. We can do that, but what happens when you add more supply of something? You typically drive the price down. So yeah, it is a risk that if we got into a sticky spot in the coming years, and I don't think this is an immediate term trend, but in the next 3, 5, 10 years down the road, if we're forced to print more and more and more money just to cover these larger debt burdens, that could eventually weigh on the characteristics of the US dollar being a safe haven asset. I would say we're a ways away from it in terms of being a reserve currency. Because as I mentioned, I think when you take a step back and you say, is the United States a place where people want to immigrate to or want to immigrate out of? I would say we're much more in the former camp, which should bode well for our country's legitimacy over the coming years.
Yeah, makes sense. And we're right up here against the hour. Nick, a lot of jam-packed information. I think as you alluded to in the beginning, a lot of different charts this time. I think a lot of information to digest. Really good information. Honestly, and we've got questions rolling in, so if we'll take a few minutes just to answer a few of the ones that we don't get to. We'll definitely follow up. One in particular from Karen. on that last slide you had about the rating drop. Do you think that may affect possible businesses, may affect businesses that are maybe planning to move to the United States from Europe, or anybody kind of locating into the United States?
I don't, and I think that for a couple of reasons. One is Europe's in a much worse situation than the United States is in from a manufacturing standpoint. If that point wasn't driven home from the PMI data, I can show the chart again, but manufacturing in Europe looks pretty tough. And I think if you're trying to figure out where to build a new plant or where to expand new operations, I think the United States still looks like one of the bright spots, if not the bright spot. Certainly there are some developing economies that I think look like pretty interesting places to be as well. But on a very large basis, I think the US is one of the best developed spots to be.
This is a really interesting question from Tom. I've wondered it often, is how accurate are actual when they get revised several times? So like when the charts come out, they have an actual, right, and then they get revised. How I guess, where's the accuracy there? What's the accuracy there?
Yeah, I mean, every index has got a different variability in terms of how large those adjustments can be. I was actually looking at, let's see, I was digging into industrial production data, and they do 4 updates and revisions to their data, and it can change. They said on average between the first data point and the 4th revision, which happens over a 4-month time period, they view that accuracy can adjust by 0.3%. So as we sit here today, if we take the original data point of negative 0.3, I think it's 0.4% is where industrial production year over year is. And that was one of the ones that we were saying does a fairly decent job of preceding recessions. If it's at negative 0.4 and on average, you would say adjustments shouldn't impact it by more than 0.3%. Even if there is an adjustment of 0.3, it would still keep you in negative territory. I think that might be where they're kind of trying to get to. Some economic indicators don't have revisions. The GDP certainly does, and that one's a very frustrating one because they print it like the first month of the following quarter, and then you don't even get the 3rd revision until the end of the next quarter. It kind of loses its luster by the time they move it all around. But that's the art and the science behind some of these economic indicators. There's a lot of smoothing, a lot of math, a lot of assumptions that are involved that are way beyond my pay grade. But yeah, they are. Adjustments can happen, and it stinks when they do. But all of this data that we show today is as fresh as you can get.
Yeah. From Scott, based on what you're hearing, reading maybe from recent earnings calls and such, do you see carbon and steel mills continuing to keep a tight leash on output?
Yeah, I think they're going to keep a fairly muted approach to output. Yeah, we're still in kind of the high 70s range. I think they're going to continue to do that, and not because end markets are necessarily bad. There are some end markets that are quite strong. Caterpillar, for example, just reported very strong earnings. They did cite a little bit of weakness in construction spending out of China, so specifically noting China weakness. But here within North America, they noted very solid numbers. And I think, not that we're talking stocks, but their stock, I believe, just hit all-time highs just a couple of days ago. So yeah, there have been some really bright spots within the industrial side of things. Automotive, as we mentioned earlier, seasonally adjusted automotive sales are they slightly missed expectations, but they're between 15.5 and 16 million units right now. So they're looking pretty solid as well.
And to close, I wanted to get to this from Brian. And Nick, you always call yourself Dr. Doom, and you always saying, things, don't, take this with a grain of salt and all that. But this comment really, I think maybe got me down a little bit. But it's clear to me while listening to all this that the service sector may be buoying the economy, kind of despite all expectations. Right? So maybe that was spending off government stimulus. Then I heard that consumer debt is approaching up. So maybe that's stalling the inevitable recession. However, if we're being maintained by debt, then maybe that's going to make the downturn, when it does finally happen, all the more severe.
We should invite that person on to be the real Dr. Doom next time. But no, I think it's a risk. It's certainly a risk. The manufacturing economy is a cyclical one. We get through, we could pull up a 5-year chart, we can pull up a 15-year chart. Every couple of years, there are cycles where we see significant growth, and then we see a cycle where things cool off a little bit. It feels like we're in a cycle that's cooling off a little bit, but we've had one heck of a run over the last 3-4 years. there are even still some bright spots that look quite good within the manufacturing world. It's not across the board, but they are out there. I guess my point is this too shall pass. This will be something within the manufacturing economy that at some point inventories will get low enough. People will still need things to make stuff. And when they need it, and it all happens at the same time, we'll get back into another boom cycle. So it doesn't have to be doom and gloom. And we have the unfortunate situation where, at least for my entire career, the only two recessions I've ever seen were when I first got out of college, the 08-09 recession, which was horrific, probably the worst in 100 years. And then the COVID lockdowns, which for a different reason were the worst anybody's seen in 100 to 150 years. And that's what we think of when we think of recession. And I just don't think that needs to be what's predominant. I don't think that's what's normal. I don't think that, because I could even make the argument that we had a manufacturing recession in 2015-16 and the broader economy didn't feel it. So I think those types of things happen, and we don't get a quote unquote recession, but we get a manufacturing recession, and the show goes on. I do still have personally, I mean, I look at a lot of these charts and I do have the concern that we haven't yet felt one of the fastest interest rate hiking cycles and potential tightening cycles that we've seen in a while. And I do think at some point that's going to tighten the reins on the economy. And I would even argue that if you really got Jay Powell with a couple cocktails in him, he would probably even admit that's the goal, is to take a little bit of steam out of the system and get things back to a more normalized business cycle, because we shouldn't address the last 3 years as a normal period of time. And I think he would agree with that.
Yeah, and we appreciate the commentary, Kid, about the gloom and doom, but I mean, it gets people thinking, right? I think that's what with this data, and it's people got to put their own perspective on it. And I think that's insightful. So
yeah, and I think that's really my main takeaway is this is not to scare anybody, but we think this data is very useful. We use this data internally within our risk management team. We think it's very useful, and it's more intended to prepare. It's just to keep people's eyes on the right metrics. And some of them look a little cloudy. Some of them look fine.
Like it. That's a good way to end. Now we've gone over, but I think with rightly so. So a lot of good stuff. Nick.
Hey, thanks everyone.
Any closing thoughts here? Like as a reminder, we'll be recording in September. If you have any questions that you'd like, you can send it over to marketing@ryerson.com, and we can get those questions for our carbon sustainable limited managers next month. But Nick, closing thoughts for this month?
Yeah, no real closing thoughts. I think I kind of gave one already, but I would say if anybody's got any questions that they want to send our way, if we get a little extra time to prep, I can prep some correlation analysis and some charts and stuff like that. We can actually give you some hard data around what oftentimes is me just kind of rambling on. But yes, so send questions our way to the extent you ever have them in between Cup of Joes. And if anybody has any thoughts on a good college football or professional football bet, we should definitely get it going here in the next 30, 45 days.
Love it. Great.
Thanks, everyone.
Bye-bye.